Okay, so hi. So we're going to talk about the double declining balance method of depreciating. So there's just a few things to know about it that differ from the straight line method and from the units of production method that you may have learned about. So in both of those two methods, you learn to take out residual value before depreciating it. So in the double declining method, it's different because we don't take out residual value. Instead, we just don't depreciate it past that residual value. So you will not say cost minus residual value or salvage value. You'll just start with your cost. All right, that's one thing to know. The next thing to know is that you will be taking your straight line percentage, which can just be 1 divided by the useful life, and you will double it. That will give you your double declining rate. And the last thing to know is that each year that you depreciate it, you will use your carrying value of your asset. That means your cost minus how much you've depreciated it from previous periods. So let's put some numbers to this and show you what we're talking about. Equipment was acquired at the beginning of the year for a cost of $600,000. The equipment was depreciated using the double declining balance method based on a useful life of 16 years and an estimated residual value of $10,000. Because this is double declining balance, you will not use that residual value of $10,000. All right, but we do need to find out what our rate is. So the straight line rate would be 1 divided by the useful life. So you would have said 1 divided by 16. That would have been your straight line method. We double that, so we just multiply that by 2, and our rate will be 0.125 or 12.5%. That will be your rate that you'll use for the entire problem. All right, the carrying value. Well, in year 1, the carrying value is just your cost because you haven't depreciated it yet. So the cost of this is $600,000. So for year 1, we will say $600,000 times 0.125. So what was the depreciation for the first year? It would be $600,000 times 0.125. So we get $75,000 for year 1. And then it says, assuming it was sold at the end of the year, the second year, for $480,000, determine the gain or loss. So before doing this, we have to figure out what is the depreciation for year 2. So we know that for year 2, we need the cost of the asset, which was $600,000, minus the accumulated depreciation, which is just 1 year's worth. So it's $75,000 right now. So the carrying value at the end of year 2 to depreciate it is $600,000 minus $75,000, so $525,000. We still multiply that by 0.125 because that's our rate that we'll use each time. So we'll be depreciating at $65,625 in year 2. All right, but they didn't ask that. They just want to know what is our gain and loss if we sell it at this point. So really we have to figure out what our carrying value is after year 2. So if we just copy the same formula over, because that's just what we need to do each and every time is this carrying value formula. Oops, well, that was okay. Let's see. Let's do it like this. All right, so the cost of the asset was $600,000. Now our accumulated depreciation is year 1, which was $75,000, and year 2, which is $65,625. So our carrying value right now is $459,375. That's our carrying value. So we compare that to the amount of money that we received when we sold this. That's called our proceeds. The proceeds that we got for this, it says that we sold it for $480,000, so we got $480,000. And we'll call that proceeds. So we compare the carrying value to the proceeds, and we got more than what our books say it's worth, what our carrying value is. So that means that we have a gain. And our gain is $20,625. And again, that's because the money that we got is bigger than the carrying value at the time that we sold it. So we have a gain of $20,625. All right, then it asks us to journalize the sale. So if I sold my asset for cash, I got cash, so cash goes up for the amount that I got, and it says that I got $480,000. I need to get rid of whatever's in my accumulated depreciation account. Accumulated depreciation has a normal credit balance. So far I've credited it for both years' depreciation, which I can see right here is $140,625. So it normally has a credit balance, so I need to get rid of that account. So I'm going to debit it, and that's accumulated depreciation. Then I need to get rid of what's inside this equipment account. And equipment has a normal debit balance, so to get rid of it, I need to credit it for the original $600,000 because that's how much is in there. And then I need to show my gain. I need to recognize my gain of $20,625. And so I need to see if I'm in balance, so I'll add together my debits. When I add those two, I get $620,625. And over here, I also get $620,625. So that is my journal entry to sell this asset at a gain. All right, so if you're having any trouble with this journal entry right here, it may be that you need to make the journal entries for year 1 and 2 to understand what's going on. So when we depreciate under any method, we always depreciate with depreciation expense and accumulated depreciation. We would have done that for year 1. Year 1 was $75,000. Year 2 would have looked the same. Depreciation expense and accumulated depreciation. But it would have been for year 2's, which was $65,625. So at this point, if we want to get rid of what's in the accumulated depreciation account, we can see we have a credit balance of $75,000 and a credit balance of this. If we add up these two numbers, we can see that that equals the $140,625. That's the number that we need to get rid of. It has a credit balance, so therefore we needed to debit it right there. That's why we did that. When we first bought the equipment, we debited equipment for $600,000, so that's why we have to credit that. And then a gain has a normal credit balance because gains work like revenues, and if it would have been a loss, it would have had a normal debit balance. So let me make one more distinction because this confuses students sometimes. So over here, we're debiting cash because we got cash, so cash needed to go up. Right here, we're crediting gain because gains have a normal credit balance. But this account and this account, we're getting rid of. So that's why we're doing the normal of its regular balance, its normal balance, because after we sell this equipment, it's gone. So we're doing the opposite of its normal balance because we're getting it off of our books. So that's why you want to make the distinction and say, I am getting these two accounts off my books. I'm recognizing that I received cash and I'm recognizing a gain. So that should help clarify why we're doing the normal balance for these, but yet the opposite of the balance of these. It's because we're removing these from our books, but we're recognizing that we got cash and we have a gain. So let me know if you have any questions.